Hello and welcome back. I'm Dr. Stock, Doctor of Education, and in this video, I want to talk about household debt and credit, because from the Federal Reserve Bank of New York, we just got their new report today for Q1 of 2023. There we go. And I did talk about this back when we got the Q4 report for 2022 and talking about what we could possibly see. And in this one, I decided to take a little bit more of an in-depth look based on some of the results that I saw. So that's exactly what I want to share with you in this video, because I want to know, are we going to see a recession in 2023? Is the consumer strong enough? Do they have strong enough spending ability to maintain economic growth throughout the rest of 2023 into 2024? And I sort of want to put some ideas out there, put some feelers out there, and you guys are welcome to let me know what you think down in the comments for this video. I'd absolutely love to hear from you. So also, in this video, you'll hear me talk about Moomoo. It is the trading app that I use and in these videos. And if you sign up now, you can get up to 20 free stocks for a deposit of $1,000 or more. Each of those stocks valued up to $2,000. Just by depositing $100, you get up to 10 free stocks. So take advantage of that offer. You can find that link down in the description. Also, don't forget about the link for the Patreon while you're down there if you need to hear more about my exclusive content and be a member of my private Discord community. That link is also down in the description. That said, let's move right on to household debt and credit. So let me pop this back up here for you. And like I said, this is from the Federal Reserve Bank of New York. This is an open source. This is a very open, free to download, very available to everyone sort of document. And when we look at this, it tells us a little bit of a summary about where the different debt sources come from. So let me scroll down and we'll start talking about that. So when we look at this, one of the very first things to notice is that consumer debt is now up over $17 trillion. So we sort of broke over that from the last time. You can see not too much of a change. That's just a huge amount. Look at mortgages taking up 71% of that. And then HELOCs, the home equity line of credit's about 2%. That's actually one of the interesting areas. And I want to share that with you. Actually, I have the numbers in a spreadsheet that I put together for you. And I think you'll like what I have for that. Auto loans, credit cards, student loans. And like I said, you can download this from the Federal Reserve Bank of New York's website. You can just go, you can get it, you can get access to the data, you can download it, you can look through it all. I put it together for you in this video just to talk about some of the things that I thought were very interesting. Now, credit cards are actually one of the very interesting areas that we have. So credit cards are interesting because the debt level for credit cards, so credit card debt remained unchanged from the previous quarter. So let me bring up my spreadsheet, because rather than looking at these tables and stuff, I think looking at the data that forms these tables actually is a lot more informative. So let me bring that down, pop this up, and here's the spreadsheet. And this comes from their data. All I did was I went through and found the percent change for their data. So we have the home equity revolving credit, we have credit cards, and they also kept the total. There's other columns, and I hid those columns just because I want to focus your attention on these. Matter of fact, this actually enables me to even zoom in some more. So let's make these even bigger on the video screen there for you. Oh, that's gorgeous. Okay, so this 03 that you see, this goes all the way back to Q1 of 2003. So this is about 20 years of data that we're looking at. And all the stuff that's in red that comes up for these numbers up here, these are numbers of interest. So let's talk about revolving credit, then we'll talk about credit card, we'll talk about the total, and we'll keep this plain and simple. Look at all this red that we have. These are all positive numbers for a home equity revolving credit lines that we have. And really, 2003, 2004, they really blew up. And because they're positive, that's an increasing level of debt in home equity line of credit when we look at those values. And then when we get into the housing crisis, look how quickly this changes from all that red that we saw to all this black that we see starting in Q2 of 2009, that those values just start dropping, that people are paying off those home equity line of credits that we see, that the debt is no longer increasing. One little blip there coming along in 2011 and Q3, that's just one. There is one more if we scroll down. There we go. 2016, there's the second one that we get all the way since 2009, that those home equity line of credit balances have been dropping. And keep on scrolling, more dropping. Let's look for the red, there it is. 2021 and Q4, finally, it increased a little bit, came back down in Q1, and then look at the next 4 quarters that we have. So this is the most current quarter, and those home equity line of credit balances are increasing for the first time in a long time. And really, I think it speaks a lot to the consumer and the fact that inflation has really taken its toll, and that people, I mean, I think honestly people are strapped, and I think that it's going to get difficult, but it's going to be debt for a little while before it becomes unmanageable debt. So we'll talk about that in a little bit too. Let me scroll back up. And I also want to point out when we look up here, while we're looking at the credit card column, so this NA is because this is a month-over-month value that quarter-over-quarter value that we're looking at from the previous quarter. So I don't have the quarter 4 for 2002 included in the report, and that's why I can't give that value there. So don't have that value. I will look into it and see if I can snag that for you. But what I want you to pay attention to, look for the yellow bars. So where I have the yellow background, that's Q1 of 2004. And notice for credit cards, so now we're looking in this column, Q1, red, all black around it. So these are all increases in credit card debt. Santa Claus season ends, holiday season ends, and then look, some of that credit card debt gets paid off. Increase, increase, increase up through Q4, gets paid off. Increase, gets paid off. Increase, gets paid off. And I don't mean paid off entirely, but at least paid off partially. That in Q1, we have some of that debt decreasing on credit cards. And we can keep on going up through 2008. There's Q1. And now, mind you, look at all the red that we get when we see the Great Recession. Look at all that credit card debt that was getting wiped out over that time one way or another. But just pay attention to the yellows, because you'll notice each time consistently, Q1 every time gets paid down from the preceding quarter, that holiday season before it. And that's significant. So let's keep on scrolling, because that keeps on happening every time until we get to this one right here. Let me put up higher so it's in the middle of your screen. I'll even zoom in a little bit more for you. There we go. This is the first time in a 20-year history that we didn't get a decrease in the first quarter of the year when we look at credit card debt. And we also have this increasing amount in the home equity line of credits that we have these balances. So between these balances, they're finally increasing. People are taking money out of their homes in order to pay for other things. Maybe they are doing home improvements. Maybe they're investing some of that capital. Maybe they're bailing themselves out. Who knows? But that combined with this little detail here, I think this would be a really early blip. Now, mind you, it is worthwhile when you look at these numbers. 6.5% up in credit card debt at the end of 2021. Drop at Q1, but that happens except for this last time. But then look how these sharp increases that we get in credit card debt throughout 2022 as prices continue to increase. And like I said, this is the first time that consumers hadn't paid that down, that it stayed even with the previous quarter. So you're like, well, it didn't go up. Well, it didn't go down. And that's for over 20 years time. That's exactly what it did. And I think that that's concerning. So one of the columns that I have hidden in here, actually, let me pop this out, unhide those so that we can see the student loan balances. This, I think, is actually really going to come into play, is student loans over time. And even though I don't know that there's too much of interest in here for the student loan balances, I think something that's important to pay attention to for the student loan balances is the fact that the student loan moratorium is still going on, and I don't think that the consumer has a whole lot of strength. Now, I found mixed things for what age group demographic contributes to GDP, but it seems as though there's at least 30% of the GDP that is brought to us by the 18 to 49 age group, and then that 50 through death, I guess, would be that other 40%, out of about the 70% that makes up GDP. Don't quote me on that one. If you guys have a better resource to break down GDP by age group, I would absolutely love to have access to it. I'm still looking for that detail, that information, because, and the reason that I want those age groups that we're looking for, 18 to, actually, I think it's 39. When you look at debt by age group, that's an important group because they have the majority of the student loans. And then 40 to 49 still has a lot of student loans on them. And then as you get above that 50 and onward, there's still some student loan debt, but not nearly as substantial. And all of that comes due in Q3. And then what does it look like when we get to that point? And something else that's included in those reports is that they talk about delinquencies. And right now, delinquencies for student loans are like at about 1% for the 90 plus days. I forget what they call it, severely derogatory delinquency or something. And that it's really, really worthwhile to pay attention to. So I'm really concerned, as I talked to you about in this video at the beginning, is the ability for the consumer to continue strong spending habits. And really, it depends a lot on how much they're able to kick that can of debt down the road, sort of like with the debt ceiling of the federal government kicking the can down the road with that debt ceiling overhanging us. I don't think that is it is a long-term problem that's going to have to be dealt with. But near term, even though it might cause some volatility in the markets, I think it's something that gets smoothed out. And then, when it rears its head up again a little bit later this year, possibly December, if that's when they delay it to, and then we deal with it, then we could see more pressures in the markets. But for the consumer and their debt, they can actually kick debt down the road quite a while. However, with student loans coming in and being sort of an unexpected shock to the system, that could be something that causes pressure that we didn't necessarily think would happen to cause things to get messy so quickly for a lot of people. So if people are already dipping into credit and they weren't able to lower their debt on credit and they're tapping into their homes for that sort of equity, where else do they go to get more of that money? And employment, we already see that employment, we have a tight labor market. There's already a lot of people, if they want a job, they go out and they get a job. That there's also about 1.6 jobs available for every one person seeking work. So these people are already seeking work. They have the jobs, and yet we see home equity line of credit balances starting to increase. We see credit debt start to pause on us. And, maybe these are just some early signs, just some bellwethers to tell us what is up and coming for us. And I think it's very worthwhile the next quarter that comes around, it'll come around for us in August, to really pay attention to what we see there, along with other economic indicators. Inflation will likely continue to moderate. The Fed will likely maintain their pause. If something does break along the way, maybe we actually see them pivot to the point where they start doing rate cuts. And my whole reason for doing all of this is that I want to know if we're going to see a recession, because that answers the question of whether or not I'm positioned correctly in my portfolio with the short hedge that I have. And if I do believe, as I go through and I look, that the consumer is stronger than I expected and that recession is something that will be avoided, and maybe AI is that wonderful thing that increases productivity so much and the companies got so lean throughout the pandemic, throughout their work staffs, and maybe there's even enough pricing power in there that so between the efficiency to cut costs, and then also on top of that pricing power for the goods and services provided, maybe the economy does hold out, in which case, if we're going to see more of a bull run, I want to be ready for that as well. So what does it come down to for my base case? Actually, I do want to share this real quick. Let me bring this up and then I'll talk about that. So this total that we see up here, this is the total debt, and like I said in black, these are all increases, and the red is where we see a decrease. So as we go, let me actually go back to the beginning, because it's worthwhile at least to see that debt typically increases over time. We're kind of used to that. We can see it in the charts too. You can see when the Great Recession hits, because everything goes red when we look at those totals. My apologies, my picture was covering it. And then a little bit of a blip in Q1 of 2011, and then kind of a little bit up and down for debt following that, and then increase for a while. There we go. And then that brings us down to about where we're at right now. And I do have some medians and some averages down here for you to look at, just to see how unusual it is for these different values that we have. So you can see, for example, that credit card debt, typically the middle number for that by position is about 1%, just shy of 1% every quarter that goes by. And the average of that is about 0.5%. And you can see with this one, like I said, every quarter, but this one in the past 20 years has been negative. Base case for this. People have asked me, do I expect to see a recession? For 2023, I think it's highly possible, Q3, Q4, that we see it. I thought possibly that we see it being pulled forward as soon as Q2. So you can look back at my other videos, some of my live streams of StockMo, some of the other evidence that I have, or some of the other things that I think are going to play out as we watch those. In the debt report, by the way, they also do mention the fact that some of the median credit score has increased by 10 points. I think it was for auto loans, indicating that there is some credit tightening that's taking place in the background, which can also sort of have a slowing down effect on the economy, sort of like the federal funds rate increases do. So I think there's a lot of reasons to be cautious with this market, and some people believe we're already in a recession, and I think it is highly possible that we really are seeing one right now. And it is possible that the market might actually bottom sometime during 2023 before rallying back up again. And honestly, I'm going to be very intrigued to see what plays out for Q3, because that'll be our first full report that we get, a quarter of having student loan payments, I should say, back in full swing. So I wanted to come out and share this with you. And, let me know if you found it interesting. If you have any questions, concerns, stories that you would like to share, hit me up down in the comments. Hit that like button. Get your free stocks from Moomoo. Don't forget about joining that Patreon. That link is down in the description, along with the Moomoo link where you can get your free stocks just by depositing either $100 or more. And thank you guys for watching the video. If you like what I had to say, hit that like button, hit the subscribe button, and ring that notification bell to see any time that my videos come out. I am Dr. Stock, Doctor of Education. We'll see you in the next video.